Post-Shakeout insights and tail risks ahead. Welcome to our monthly FSC vlog here today, December 19th, 2024, with your host, Ron William, Development Director. Our focus today will be on latest insights post-Shakeout and just what that means here on into the new year. The S&P 500 risk proxy in terms of that bull trap reversal that is now in play. And then to close, the spotlight to our main theme for this FSC vlog, which is 90 seconds to midnight. All of this can be reviewed on video on the FSC YouTube channel, as well as in recent media interviews with such platforms as Real Vision. Trump 2.0, the ongoing election playbook that I've been recommending based on statistical analysis of past, present, and likely future, is this idea of a two-stage pattern and a buy the rumor, fade the fact. Now, what better way to describe that strategy than this cartoon image developed by Credit Eye? And you can see there Trump apolitically looking confident in his new president-elect inauguration, Jan 20. But as those bulls paddle as fast and as confidently as they do, there is one in the very back looking a little bit anxious, wearing a life jacket with a speech bubble just in case. Now, this is a lighthearted, humorous note, but on a deeper, more meaningful level, it invites us to have our biases in check while also thinking laterally outside of the box. And this is the real intention behind sharing this picture with the underlying chart down below. You can see the buy on the rumor first stage elevation is going into the election by a month or so. This time around, it was a week just before, where the odds switched from 50-50 either way in favor of Trump and the Republican Party. Of course, the rest is history. There was a red sweep. And ultimately, as we go into the new year and the inauguration of Jan 20, there tends to be an unwind thereafter as part of what we refer to as fade the fact. Now, there are two key factors for this. One, profit taking from overbought conditions, which we're already seeing right here, right now. Two, the policy stress test. And it's really important that we understand the policy angle here. Any new president-elect the world over, especially when they have big policies and big promises, will go through a stress test reality check in that they need to match their campaign trail promises with the reality on the ground. And typically that creates a lot of change and uncertainty, with the resulting volatility for at least the first few months, if not until the midterm election, where voters can really vote with their feet again and give a vote of confidence or not. Okay, so that's the general theme. Trump 2.0 election playbook, buy the rumor, fade the fact, in play as we speak. Behavioral insights from Mr. David Fuller, a longtime veteran market strategist, investor, and student of crowd psychologist, who was also a mentor of mine for some years. Great insights from him is sudden dramatic change is never anticipated by conventional wisdom. And we've just seen that here and now. A lot of people are saying it's post FOMC, and there could be, the market could be pricing in a potential Fed mistake. Time will tell, but take a step back away from FOMC and just think about the whole idea of unexpected events, sudden dramatic change that ultimately conventional wisdom not being able to anticipate. So whatever the headlines might be saying, let's disengage with that for a moment. Now, what's interesting is if we take that step back and look in time, we can see that there have been notable event shocks in the past, such as the pandemic of 2020, generationally high inflation, 2022. We all know the cost of living crisis that followed since, heightened geopolitical risk from that era, Russian-Ukraine invasion, and so much more thereafter, Middle East this past year, 2024, which is still boiling over. And of course, just recently, we've had events in South Korea with potentially more to follow. Time will tell. Now, having said all of that, despite the precarious zeitgeist of the past, 2024, the year that has just passed, proved a good year for investors. And so perhaps the market truly did walk a wall of worry. And here and now, as we're just seeing, a potential unwind, that is from risk assets hitting greed extremes and fear sentiment previously at record lows. So let's keep that in mind as a big picture framing of where we are now, how far the elastic band has stretched, and ultimately the likely snapback effect when we least expect it. Could this moment be part of that early stage disruption? Time will tell. Now, if we look at the big picture, record investor exuberance, which we're unwinding from. Remember the bird's eye view, which really gives us a much better context as to what we're seeing day to day, especially when we're getting fast corrections in the market. Let's keep in mind two factors that are overstretched. One, momentum, and two, positioning. On the momentum side, an interesting measure is the number of all-time highs we have seen on markets like the S&P 500. If you count it up, it's double digits, 54 all-time highs in this year alone. And that record is only matched by the bull market of 1920. So that just shows just how bullish and record all-time highs the market has been. It also gives us an idea of a potential dilution effect of the whole meaning of all-time highs, which is something we should keep in mind. Yes, it's bullish. Yes, if the market's up and we're long, we're making money. But for how long? That linear trend effect starts to lose its gravitational pull after a while, particularly when it's happened 54 times. And of course, it gives that under the surface frustration of, yes, it's a bull market, but it is under pressure the more and more we get closer to that mountain peak. Now, to follow, positioning in terms of the liquidity that's driving this is also compounded from extremes, both in terms of retail and institutional flows at extremes. So we can see both momentum and positioning as part of that elastic band being very stretched, and ultimately juxtaposed with the beneath the surface blend of indicators that have become rapidly less supportive. I've been talking about that for some time with the FSC monthly vlogs, as has some of our team members too. So the asymmetric risk is now greater, with a continued rally more dependent on momentum chasing, risk on rotation, and hotter fund flows. And this really helps explain the coin flip, fast reversals that can happen in the market, and often leads to big and fast corrections. Another way of describing this phenomena is the greater fool theory, where ultimately the last buyer has bought and then a price vacuum gets developed before we get that cliff drop from the mountaintop. Let's review the global model rotation, which is a systematic framework used by myself at RW Advisory. Essentially, it's a look of trends over time, long-term, medium-term, short-term. Many of you FSC members may recall past spotlights on this. Here and now, it shows a tale of two stories. One, the Trump 2.0 risk trade is in shakeout mode. Three key examples are Bitcoin, overbought, unwind, sub 100K milestone, having just broken above that in a climactic way. We're now unwinding the other way. S&P 500 bull trap reversal, question mark, a risk I've been highlighting for some time, which is now in play. And then finally, the US dollar corrective unwind too. Now, remember, this is all part of a revival of animal spirit, pro-economy support for the president-elect win of Trump. So we know that story, and that story seems to be already unwinding from those election fever highs. The second part of this is inflection proxy resurgence, which is likely the story behind the story. We can see here in benchmark 10-year government rates, break-even spreads, charging up higher here on the chart. You can see here in pink, US 10-year, all the way up to the top of this ranking model. Remember, it's trends over time. And then, interestingly, as part of that inflation resurgence, we're now starting to see commodities revive from oversold conditions, not in absolute terms, but in relative terms. So relative to other global cross assets, oil and copper are starting to hold their ground and may find a base strong enough to actually unwind higher in an absolute and relative basis. Gold is sideways after unwinding from a very strong uptrend, 40% from low to high, 10% more than the equity market this year. But after a strong trend, it is still within a volatile range and a potential buy on the dip opportunity. So that's the global ranking model, a tale of two stories. Trump 2.0 risk trades shakeout and inflation proxies resurgence, the likely story behind the story. Let's do a quick flash update on S&P 500 bull trap. We'll look at three key factors. One, trend pattern reversal based on the Elliott wave principles of behavioral fractal patterns, as well as some timing short-term windows that we're currently triggered and will still move into over the next few weeks of December. Two, a momentum exhaustion based on DeMark indicators. And then lastly, a range of different timing cycles that have been calling for this overdue bear market shakeout. Trend pattern reversal. This is the updated chart showing a potential wave 5 confirmation within this rising channel, which clipped the 6100 level, broke below the milestone 6000 level, and now, most importantly, new low breakout reversal beneath the prior swing low, the wave 4 of the wave 5, and the trend support around 5900, now confirming a likely wave 5 trend reversal. Elliott waivers may have a variation on this trend reversal pattern, but either way, it's a trend reversal confirmed here and now. And so long as it holds below 5900, this remains a bear case to follow. And certainly we should be aware of further downside risk, and I'll speak more about that in a moment. Let's also keep in mind not just the price pattern, but the time window. And you can see here some time factor signals based on natural cycles showing the quality of the price move, that exuberance coming into check with some of these time factor inflection points now adding pressure to that bullish stance. That's also confirmed by bearish divergence on the momentum indicator. And keep in mind that there's another timing inflection point coming in the second half of December along the same lines of checking the exuberance, but this time in terms of potential more learning, more pressure, and more anxiety about some of the macro changes, such as inflation, and of course the FOMC decision that has come to pass and their expectations of what's to follow. Now, if we look at the runaway exhaustion signal based on DeMark indicators, we can see a triple whammy exhaustion signal. That is a daily, weekly, and monthly exhaustion signal. And most interesting is this election price gap that we are currently testing between 5860 and 5700. That will be an important price footprint in the market if we manage to close below that gap. Then that will be an important milestone for the bears to have retraced that election gap event risk and likely suggest further downside thereafter. But I want you to check the exhaustion signals. And the number 13, it's based on systematic mathematical technique, again, as I just mentioned, developed by Tom DeMott. You can watch some of his market insights with the firm Symbolic, and also some of the guest presentations that he's given with the Foundation for the Study of Cycles. Look at the red 13 appearing across each of these timeframes, and ultimately the confirmation playing out as we speak. The risk zone is 61.70 on the near-term basis. We failed below that, and we are heading down lower. We need to break below 5,700. You can see that's the low side of the election gap, and that would then target 5,400 and 5,130 for those of you who are looking for key downside trigger levels. This would all coincide with a larger bull trap signal, which I've been alluding to, akin to the 2008 global financial crisis three-wave corrective pattern. Not a one-for-one in terms of macro event risk, but in terms of price and time pattern, very similar. Now, if we finalize on the timing side, remember the election playbook, buy the rumor, fade the fact, we can see this two-stage pattern with the market euphoria rising into the POTUS result and then unwinding thereafter into the new year and inauguration. Equity market performance is further enhanced, would have been by the year-end seasonal rally, which is now likely going to be muted, depending on how the market closes in the next few days and weeks. But essentially, beyond that, remember, from an election pattern standpoint, there's typically an unwind, both because of profit taken from overbought conditions and policy reality check, but that typically extends into the first year, into the mid-year election period. Remember, I mentioned that at the top, and this is the chart from Fidelity showing that 1 year, or at least half year, sideways to down underperformance phenomenon. And if we look at the cycle model based on the Foundation for the Study of Cycle software, we can see the updated version already bearish, but bearish highlighting a divergence, a lower peak, and ultimately a slower rate of change, which is what we've been seeing in the market, more down days than up days, and now finally a rollover. And most importantly, a mean reversion risk into the new year, inauguration Jan 20, and the spring months of March and perhaps April. We can look at that closer to the time and update everyone. But all of this can and will likely be part of a long-term topping pattern. This is what the big debate now. Is this going to be a shallow correction here and now as part of a short-term tactical unwind from overbought conditions? I think most people agree with the need for this type of move after such a strong outperforming year and 2 years together. But the bigger question is, will this be a greater top or not? So my view continues to be yes, the risks are high that it is a major top, but will this be in the first half or the second half? Better to look at the market price action aligned with the timing indicators to have a better read day by day and week by week. The one thing that I think is telling is if you look at external data based on macro sentiment and how that influences markets and mood, think of MMM as an acronym, that is based on solar activity, which peaked in the past summer months of 2024 and suggests that we will have a peak top reversal, major distribution pattern in mood and ultimately markets next year. And we can work it out first half, second half, according to the short-term timing data. So there's a variety of different timing indicators, all confluencing, focusing on that downside risk ahead. Now let's briefly focus on the macro side of things and this theme of 90 seconds before midnight, which is an important segue for us to step out of the market game and to look outside the window in terms of the turbulence that has been taking place throughout this year and beyond, and likely into the new year of 2025. What is this 90 seconds before midnight? It's most interesting if we look at macro scenarios in good, bad, and ugly terms. And this is something I've done for years now as part of what is referred to as scenario planning. Being forewarned allows us to be forearmed. Now, this is a strategy technique that has been around for decades in business and in the energy industry, but for trading and analysis, it can be quite useful. Here you can see the probability of positive or negative outcomes in the market, both macro and general. And on the right side, we have Trump 2.0, reflation, expansion in the economy, a positive effect from his so-called tariff policy, which could lead to a melt-up. These are a few positive risk scenarios, the so-called white swan events. But if you look at the other side, which is more likely because markets are elevated and continue to warn of asymmetric risk, the left tail highlights three key event risks: geopolitical shock, policy mistake, which a lot of people are talking about now post FOMC shakeout, and ultimately a risk unwind, which seems to be in play already. Now, either way, it could be one, more, or all of these factors together as part of a domino effect. The next question is, what do we do? And from a portfolio trading strategy perspective, the recommendation is to consider a barbell strategy, where if we continue to be long in some of the trendy risk markets, we should be selective, where possible, take profits, and more so, especially after the recent shakeout, look for some downside hedging positions. Now, of course, if we're looking to trade, we can just take a short position. But if you're thinking from in portfolio terms, you might want to try to find this balance between risk on, risk off, as we get further evidence of a potential unwind ahead into the new year. Now, where am I going with all of this? The 90 seconds to midnight refers to the fear of a doomsday clock extreme. The so-called doomsday clock, which already struck 90 seconds before midnight earlier this year, Jan of 2024, is the closest it's ever been to midnight since its inception in 1947. Another way of thinking about it is things have not been this bad since the World War years, according to this metric. This recent pendulum swing was largely attributed to the risk of the nuclear escalation that rose from Russia in invading Ukraine. 1 week after the US election result of President-elect Trump and the so-called peace dividend that he was promising, there was a tick-for-tack missile exchange between those two nations, which certainly did escalate things. And then, of course, we had more of the same Middle East tensions continue, and just recently the unwind in Syria with events also taking place in South Korea. So there's a lot of headline news outside the window in terms of global affairs and geopolitical risk. And the question here is, should, contrary to popular consensus, the devil's advocate question, it seems that President-elect Trump's renewed promise for a no-war peace dividend will be stress tested. So could this be part of the stress test that we'll likely see as part of this unwind into the inauguration? Time will tell. Certainly there have been some sound bites out there as to why the escalation is happening now, before Jan 20, as opposed to later. And if things do turn out to escalate, how much of a challenge will that be for the new administration? So certain key factors there to keep in mind, which is already being discussed. But from a cycle perspective, and certainly a macro lens, this is something to keep in mind, big picture. Now, if we swing back to cycles, the contractive wave, which is the long-term predictor of interest rates, inflation, but also social mood and war, is beating the drum of inflation and war. With a next flashpoint for this year and next, it actually extends into 2030. So it's several years of turbulence. This chart is based on PPI data, inflation. It's actually originally developed by an FSC market expert guest, David Murren, of Global Forecaster. Keep in mind also, it's not just the spikes within this data point that is key, it's the build up to it. And we'll hear more from David Murren in a follow-up FSC interview that will be airing very soon, so please tune into that, along with another guest, Simon Hunt of Strategic Services, that has a variation of the geopolitical escalation view and his own cycle framework as well. We should also keep in mind several other experts which are notable and already have been publishing research and books on this for a potential risk into the new year, but more so in the years ahead. That includes Ray Dalio in his Changing World Order book, and you can see there the chart in the bottom left-hand side, this typical big cycle behind empires. He's alluding to the US or Western countries and markets as part of a unipolar shift into a multipolar world. It's not that the US loses its dominance, it's that it just starts to, let's say, diversify that much more and unwind from its all-time peak. But what that means is that we've already seen a debt bubble and big wealth gap in 2020, I think as extreme as the 1930s, according to data run by his team, which has now led to a debt bust and a likely economic downturn. But ultimately that leads to money printing, credit bubble, and then ultimately socioeconomic and geopolitical tensions such as revolutions and wars. And only thereafter do we get debt and political restructuring and a new world order. Now, if we look at the work of Strauss-Howe and their fourth turning, their crisis period is here and now, I think from 2008 to for the next few years, but they actually have 2025 as part of a war or social tension risk. And they go back on a fractal basis with their cycle, linking to 1940s, 1850s, 1790s, 1700s, and even further back than that. So I just want to highlight each of those charts. Chart one, the cycle K-wave beat of inflation and war. Chart two, bottom left, the rise and fall of empires and how this is not just a market top. This is actually a big shift, changing world order shift from unipolar to multipolar, and certainly from the US to other emerging powers. And then lastly, chart three, bottom right, the fractal timing pattern, which could be connecting next year or thereabouts with various other war shocks into the past. Now, this is the one time that it would be great to believe that this could be proven wrong, and we could see some light at the end of the tunnel, and eventually I'm sure that will happen. Spring typically follows winter, but at the same time we must stay true to the cycle analysis and the vast research with all of these experts and ask the question, how can we be better prepared for such risk scenarios if and when they do continue to unravel as part of the cycle for the markets, but also for the geopolitics of our time. That's it from our session post Shakeout and tail risk ahead. We looked at latest insights, Trump 2.0, buy the rumor, fade the fact. That's the key election playbook to keep in mind, which seems to be playing out right now. The S&P 500 bull trap reversal, looking at three key signals. And then finally, this FSC vlog spotlight, 90 seconds before midnight, and the whole tail risk here and now going into the new year. We've had some questions from FSC community, and I just want to briefly touch on them. One on the short-term cycle that I've been featuring in each of my sessions. This latest one is based on natural cycles, and one has just triggered a week before, which actually led to the shakeout that we're seeing now, and another one follows into the second half of December. It's based on natural cycles, and ultimately the quality of that cycle is checking the exuberance in the market. Here and now, it's hitting the brakes. Thereafter, it's a little bit more of an amplification of the concern of some of the macro themes, inflation being a case in point. If you have any other questions on that, let me know. Happy to respond thereafter on email or in future FSC vlogs. The second question is on decennial pattern. Isn't next year, 2025, the sweet spot outperformance outlier of the pattern? And the answer is yes. According to statistical data over the last 100 years and more, the decennial pattern typically has a positive mid-decade effect, 2025 case in point, but do know it helps to look at the negative outliers when it doesn't work. 2015 is such an example. 10 years ago, I was using that as a bullish, as part of a framework for a bullish view. Unfortunately, that led, generally that was an offside view, proven wrong thereafter, and the decennial pattern failing then is a lesson that I still remember now. And so the point I'd like to highlight there is these things don't work all the time. Cycles can skip a beat, or can be muted, or can skew. So just keep that in mind. It's not a given. It's not a fixed pattern. The second thing to keep in mind is the conditions when the decennial pattern does not work is typically threefold. One, market context. If the market is overstretched due a big correction, then perhaps that market context and bull trend rollover mutes such a cycle. The second point is think about the cause effect of the cycle from a macro perspective. Many do believe that it's based on economic growth data, manufacturing more specifically, and typically for some reason mid-decade is when both the economy and markets are doing well, and therefore we get this sweet spot in the decennial pattern. Question on that point, if you believe that macros do correlate to the decennial pattern, will that happen next year? And if not, could that be a reason? The other cause effect to keep in mind is natural cycles, which is, according to the work of Edgar Lawrence Smith, one of the potential factors behind the decennial pattern. And so therefore, it's not a fixed pattern. It has a variation of 9 to 11 years, and it's actually quite similar to the solar activity chart that I shared just today, but also in a past session I did on the decennial pattern itself. And that has peaked in the summer of this year and is suggesting a top in play now into next year. So keep all of those factors in mind as to why the decennial pattern might not work. Now, if it were to work, and if you believe that it will and are trading that way, the other thing to keep in mind is when next year will likely be positive. Could it be the first half that could lead to a large drawdown in the second remaining part of the year, or whatever variation of that you might think is possible? And the last question, which is no surprise, the war timeline. I'll quickly go back to that chart. A question here is, why these wars? Why not others? Think of this as cycles that work on a law of nature basis. They ultimately impact nature itself, but also crowd psychology, which leads us into pendulum swings between euphoria and pessimism. That is what can then impact macro markets and mood, the triple M phenomena that I've been describing. And that's what can lead to inflation shocks and war. Rather than looking for the war, looking for the timeline and matching it up, think about the cause effect and how it's part of a much bigger system, the parts that make the sum, rather than isolating it one for one. And for this reason, sometimes the wars don't hit the inflection points as we expect. Sometimes it's part of the quality of the cycle itself. And so if there is a war that you have in mind that isn't on this chart, that could be why. And the other thing is, of course, think about the scale of the war. There's international wars versus civil wars. There's major, there's minor. And so there's many war experts and cycle practitioners that have often had to differentiate between war types and in terms of magnitude, in terms of systematic impact, but also in terms of cause effect. Is there a macro driver behind it in terms of inflation, and does it match with a potential long cycle like the one that we're looking at now? Either way, semantics aside, there is a flashpoint ahead. This is a risk scenario, and ultimately it's good for us to at least consider as part of a plausible event risk. We're already seeing that in the headlines. Question is, will it continue? And if so, what will be the impact? That's it from me. Please look out for our interviews with FSC guests to come, David Murren and Simon Hunt. And thank you very much. Welcome any feedback or questions. This is Ron William, your host at the FSC Development Director. Happy season's greetings and best wishes for the new year ahead. Thank you.